Good evening. We have an exceptional session ahead of us, featuring three leaders who define the standards of investment management in India today. Gentlemen, thank you for being here. We are in Hyderabad today, and this city, we value two things above all: good hospitality and straight talk. As we say locally, "Baigan ke bata na ko." So, in the next 40 minutes, our goal should be to find clarity for our investors. Diving right into the first slide. Harsha, this one is for you. Uh, we've seen multiple quarters, in fact, couple of years of earning downgrades. Do you see that?
While that chart shows that the upgrade downgrade ratio is probably bottoming out, but we are not seeing a trend where there are more surprises and we are continuously going to see consistent upgrades into earnings. Even valuations are on the higher side. But keeping the valuations aside, from an earnings perspective, yes, I think there has been a reset in terms of expectations to a large extent. From here on, we do expect a little bit of improvement, but it'll be more gradual. Going into 2027, we do expect earnings to be in double digits, which was not the case in 2025, which won't be the case in 2026. So yes, we will be seeing some improvement going forward, but we need to moderate our expectations compared to, let's say, 2020 to 24 kind of a period.
So, earnings growth of mid-teens, is that possible going to 2 years forward?
Yes, currently our expectation is 2027, we will have about 14% growth.
Vaibhav, your thoughts here, whether you think this will be a sustainable uptrend in earnings, and if yes, what will be the ingredients that will drive the earnings?
See, earning growth has started and we are seeing evidences of that. But one thing that we have to be very careful about is divergence in the earning growth. We are seeing significant divergence across sectors in earnings growth. Some segments of the economy which are doing well are likely to report much better numbers, but we are not expecting to see a broad-based earning upgrade in the index. So you look at today's results of Eternal, stellar results, came up with very high revenue growth, 3x of revenue in 12 months time with good profit numbers. But on the other hand, we have seen slightly disappointing results from large behemoths also. So there'll be a reasonable amount of divergence, but for stock pickers, it will be a great environment where they can pick and choose stocks which are showing high quality earning growth and maybe avoid the stocks or sectors which are looking slightly vulnerable now.
What drives the earnings growth? What will be the key drivers?
So good thing about India is that 60% of our economy is driven by private consumption, and all the efforts that government has taken place over last 9 to 12 months should yield into significant uptick in private consumption. We are seeing early signs of that with auto sales numbers being very good in last quarter. Retail consumption has been very good. When we talk to the companies and promoters who are there in the business, which is driven by private consumption, they are extremely cheerful about. One other thing which we tend to forget about is last year India had a stellar wealth creation because of investment in gold. Possibly the best ever wealth creation year for Indians in a long period of time. Almost $1.5 trillion of wealth got created last year. All of this positivity outside what we are seeing on global front should lead to a reasonable amount of growth in private consumption, and that segment is something which we are very excited about.
Moving on from earnings to liquidity, do you see FIIs coming back this year?
If you step back a bit and see what led to this kind of outflow from India, right? While there have been buyers and sellers at various points of time in the market, but essentially in the last 15, 18 months, they have been largely on the selling mode. Around middle of 24 or let's say September of 2024 was a period when our valuations were at almost lifetime highs. Okay. And our earnings growth in the previous 4.5 years was in the region of, for large caps, maybe about 17, 18%, for mid caps and small caps, even higher. And in that period, we had clearly outperformed all other emerging markets in terms of earnings growth. And that had led to elevated valuations, not just compared to our own historical valuations, but also compared to emerging market peer group valuations. And at that time, our expectation on earnings was kind of dwindling. And there was an expectation that 2025 will not be as strong as previous 3-4 years, right? And exactly around the same time, some of the other emerging markets who compete for same kind of flows, when it comes to emerging market flows, they were all trading at maybe half of our valuations or one third of our valuation. China at that point of time, for example, was trading at one third of our valuations. Of course, it had underperformed for 2 decades, but at that point it was very, very cheap. Korea was cheap, Taiwan was cheap. Then there were certain policy measures from some of those governments there, which gave a little bit of hope for foreign investors to look at them as value picks at that point of time. But still, people were not very confident. Later on, President Trump came in, and the initial reaction was the export dependent countries will be badly hit, India will be better off, right? That also didn't play. In fact, the exact reverse of that played out. So, in that phase, most of the flows actually went to some of these countries which were at lower valuation and which were also, from a policy perspective, were seeing something better than what India was seeing at that point of time. And to top it, we also had this great AI led investment boom that happened in US, which still continues to happen as we speak, which meant that some of the beneficiaries of that AI play would also get re-rated, right? So most of these chip companies from Taiwan, Korea also went up. So all in all, in those 15, 18 months, Indian earnings growth came down when the valuations were high, and exactly reverse of that played out for those markets, and the flows have gone there. Now, on a relative basis, our valuation premium compared to emerging markets is not very high. It is at a 10-year average. We are still expensive, but we have always been expensive to that extent, right? And now there is a hope that from depressed levels of earnings growth, we should start seeing a little bit of improvement from here on. And also the valuation gap has narrowed. So hopefully at some point of time, we should start seeing flows coming back to India. The FII holding in India is at a multi-year low, all-time low, in fact. It's at around 15.5%. At the peak, they were holding close to a quarter of our equity capital. So definitely, I mean, the selling cannot continue forever. It will stop somewhere.
In that case, will DII flows will be able to sustain like they have done in the past?
Looks like, while nobody can predict future in terms of how the flows will shape up, but at least what we have seen is SIP numbers more or less should continue to remain steady. They have been increasing over the last year, even when the markets have been volatile. Whether they keep growing or not, at least they should remain steady, I would say. I don't think you will see a very large amount of volatility there. The only part where you will see numbers going up or going down in a very rapid way due to sentiments is the NFO flows and the lump sum flows, right? In the calendar year 2024, for example, the total NFO collection for the industry was about 1,17,000 crores, right? Roughly 10,000 crores a month. Last year, it was a fraction of that amount. So to that extent, lump sum flows and NFOs may see a dip if markets continue to remain sideways or volatile. But by and large, SIP flows should continue. And that's a reasonable sum for supporting the market. It may not be good enough to take the market higher, but at least there is a good support to the market.
Aashish, another source of supply is IPOs. Most of the people see that they suck out liquidity from the market. What are your thoughts and views? What should be the perspective for a mature investor to look at IPOs?
Yeah, so I just, if you don't mind, I just want to add one more point on this FII flow bit. Yeah, just build 2 things to add to what Harsha mentioned, which you should keep in mind. Your chart here shows about 17, 18 years of history, and what you will notice is that we are negative about 5 to 6 times. And out of that also a couple of times it is like 500 million and those kind of numbers. So if you compare India's net flows, if you compare India's FII flows with all other emerging market FII flows, you will notice two things. You will notice that India has been singled out for special treatment in the sense that India is actually the only country which has consistently got high positive flows, barring these 2-3 episodes, which Harsha described very well why we got outflows. Second thing is that on 5 trillion market cap, if you have 18-19 billion outflow, and then you look at Philippines and Vietnam and Mexico and Thailand and South Africa and whatnot, you will find that they have lot more negative flows throughout these 17 years. And as a proportion to their market cap, sometimes it has been like there was a year I saw when Taiwan was $44 billion outflow. The year when Chinese jets were saying good morning to them every morning, it was 44 billion outflow on a smaller market than us. So globally, India is the second best performing stock market after US in dollar terms. And because of that, we have actually not been treated that badly. And the other important thing when I said 2 points was that bulk of the money which comes into India from FIIs, large part of it was part of some basket like global equity, global emerging markets, right? So what happens is that you see what happened in China after 2021. Then you saw US raising rates. You saw Russia attacking Ukraine. Russia got knocked out of the index itself. So what happens is that when a series of emerging markets, when they do a self goal, if somebody removes $100 billion from an emerging market fund, for no fault of yours, you will get 20 billion redemption. So 2025 definitely was, us not doing very well. Harsha explained that. But generally speaking, all the outflows in India are not because of India. Sometimes emerging markets, from 2010 onwards, US has blown the lights out. In general, emerging markets have underperformed. Within that, India was an outlier. So if people remove money from emerging markets, you will also get redemption. If you look at IPOs, I think 2-3 things I want to clarify. One is that there is humongous generalization. There is this proverb that necessity is the mother of all invention. I have my own proverb that generalization is the mother of all discrimination, right? So when people say, a lot of times I think people's perception of IPOs is 1990s. See, back then there was no VC. IPO was VC. In last 15 years in India, there is VC and there is private equity, right? So 20 years back when IPOs came, definitely it felt like it's VC and a retail investor was taking the real startup risk, like land is acquired, factories being built, permissions are being awaited and production will start. And really, if you see, 100, 200 kilometers from Mumbai or Delhi, you will actually find some Banjar Jameen with a shed where the business never started. That was the story of IPOs. So a lot of people seem to perceive IPOs like that. And in certain space, it still may be like that. But today when IPO happens, the initial risk has been taken by some professional investors. And when the IPO comes, it's a rotation of the cap table because people who had a time limit on their capital are exiting the cap table and they want permanent capital to come onto the cap table. Second thing is that I'm not saying you should subscribe to all IPOs, but we need to be opportunistic. We are professional investors, so we have to not indulge in generalizations. We'll have to look at each one case by case. And the last point is that there is this feeling or there is this hype or hysteria created that all IPOs are tech companies or new age companies or loss-making companies. I think seriously that's far from the truth. If you look at it post 2018, like our industry, capital markets, the whole industry's got listed practically after 2018. Whether you look at asset managers, wealth managers, insurance companies, broking companies, Shrikant here has created a lot of wealth. RTAs got listed after 2018. Our entire industry got listed after 2018. You look at hospitals, diagnostics, certain pharmaceuticals, chemicals, electronics manufacturing, footwear, apparels, retailing, restaurants. So I think we look at IPOs opportunistically and we don't indulge in generalizations. You don't have to participate in every one of them. You just look at it case by case on merit.
Fair.
You should get used to IPOs because in India, promoter holding is very high. It's 50%. In other countries, promoter holding, we are one of the few countries where there is a rule that on listing you need to dilute 10% and within 3 years you need to dilute further 25%. Why is that rule there? The rule is because promoters hold too much, not because they are selling and running away. So I think there are many perspectives to the debate.
Would you share your thoughts on valuations currently?
See, I think that, I'll just add one or two more dimensions. One thing which is happening is that relative valuations, of course, compared to a time series data, like Vaibhav mentioned, because 18, 19 months, we've not done much. 18 months back, when Nifty was 26,000, we were talking 5.4% GDP growth and zero earning growth, a very different RBI policy and a very different, government was just coming out of elections. 1 year fast forward, 1.5 year fast forward, we're not talking 5.4% GDP growth. We are talking 7% or so. We are not talking zero earning growth. We are talking like 8-9% and maybe better prospects going forward. RBI and government, obviously the stance is totally changed, right? RBI is trying to boost credit, bump liquidity, reduce interest rates. Government is trying to, work more on the demand side and not just the supply side. Our sovereign rating is upgraded and interest rates are lower. So compared to our own, where we were 18 months back, compared to that, it's relatively better. And 30% underperformance versus emerging markets, that also makes it relatively cheaper. And given what has happened in last 18 months, we are relatively better positioned. I don't mean to say for a moment at all that, if the market, let's say if US market corrects, we will not correct. That's not what I'm trying to say. But we will have relatively less turbulent experience. And I think that all of what we spoke will help to protect us.
Understood. Any number that you would have in mind that, okay, below this valuation now markets are attractive, Harsha?
That's difficult to say. Historically, if you invest below long-term averages and stay put for 3-5 years, a cycle plays out and you essentially are able to get out at a reasonable valuation. So I think right now it's not about trying to time that exact point of entry which will give you the most, the maximum returns. It's about being invested and remaining invested in the market. And hopefully your exit will also be somewhere around the current valuations. If that happens, then in the interim, whatever earnings growth comes through, that should be your equity returns. It's just that some of the new investors who have come into the market have come in because equities gave such high returns and they expect it to continue every year, which is not going to happen. And already we have seen that in the last calendar year, right? But if you expect it to be slightly better than other asset classes with probably higher volatility, you will still be okay.
In terms of sectors, where do you see the, let's say, when we are saying that earnings will grow faster, where is that coming from? What sectors do we think will outperform?
Yeah, 2027, I think it's going to become a little more broad-based than 2026. As Vaibhav was mentioning, all of last year, maybe some part of this year will be still very few bottom-up stories that you will be able to pick. But as of now, if you look at earnings expectations for 2027, there are a few sectors at least which are likely to grow at a reasonable pace. When I say reasonable pace, mid-teens kind of earnings growth. So that should throw up a little more, a larger set of opportunities for investments, I would say. From a sectoral perspective, banking and financial definitely is one of those sectors. Banks, other than public sector, have not done much over the last couple of years. The valuations are not very rich. Most of the pain on the interest margins is probably behind us. We have seen 125 basis points of repo rate cut. That pass-through has more or less happened. Very unlikely that you will see very large cuts, if at all it happens going forward. So that's something which is going to be positive for banks from a margin profile perspective. Asset quality issue, I don't think there are any big asset quality issues or systemic issues in that sense. So that's also fine. And there is a hope that credit growth should improve from here on a little bit. So given all this, I think banks should do well going forward. NBFCs have done much better than banks in the last 6-8 months. That trend may continue. Some of the NBFCs may have become little rich in terms of valuations, but I think there is tailwind for even NBFCs at this point of time. Apart from banking and financials, we continue to remain positive on discretionary consumption. I think there have been a lot of support that has come from government policies in recent times, starting with tax incentives for a certain category of taxpayers. State governments have been doling out social welfare schemes. We have seen GST rejig. Hopefully, over the next year and a half, we should see something on aid pay commission as well, which is again going to be a boost for consumption. So I think discretionary part of consumption should do well. When I say discretionary, in the strictest sector classification, it may not come under consumption categories, but I think wherever there is some aspirational demand that is associated, I think all those sectors should do well. Autos, consumer durables, definitely those ones. Even travel, aviation, etc., which is where the discretionary consumption will go over the next few years. I think those all sectors should do well. Capital goods, which have done exceedingly well over the last 4 or 5 years, you will have to be a little more stock specific, because while valuations may have corrected, but the growth rates have also come down for quite a few companies. So you may not get similar kind of top-down stories there, but you may get some bottom-up stories even there.
Would you put real estate also in the aspirational consumption category, or?
It is, of course, aspirational, but only difference there is the cycle has already played out for maybe 5 to 6 years. And generally, the real estate cycles in India have been of 8 to 10 years time frame, right? So if you go by history, we are not at the early part of the cycle. We are probably midway or slightly ahead of midway in terms of cycle. So to that extent, the risk has increased in that segment. Already we are seeing a little bit of tepid
In Hyderabad, it's not 8 to 10 years. It's always real estate cycle.
Sorry?
In Hyderabad, it's not 8 to 10 years. It's always real estate cycle.
Harsha, anything on IT? Because again, that will also be the flavor of the city.
At least at Kotak Mutual Fund, we have not been too positive on IT services. The growth numbers are not too exciting at this point of time. While there may be certain mid-cap IT services companies which are doing better than large-cap IT services, but overall the sector is going to deliver earnings growth, which is going to be very tepid, not only compared to their own history, but also compared to market average earnings growth. So if you look at how sectors will be preferred, either there has to be a higher than market average earnings growth for somebody to go and invest there, or the valuations have to be so cheap that even with lower earnings, you are going to get something better out of those sectors, right? And IT services, to our mind, is not one of those sectors. Clearly, earnings growth is very lackluster, and valuations are also not very, very attractive at this point of time. So we would keep those companies in our portfolio, mainly for diversification, because these are all cash-rich companies. There is no leverage. In times of volatility, probably they will be less volatile, etc. But I don't think we are looking at going overweight on the sector anytime soon.
Aashish, what would be your approach? Would you rather go stock specific, or would you rather have more sector overweights? Where do you think will be more money made?
See, I think one of the challenges with mutual fund industry, and it makes your job very, very difficult, because you have to identify best performing fund managers, and your job is very difficult because every 2 years
My boss is right here, so
so you should appreciate his difficulty. You listen carefully.
I always appreciate.
So the difficulty is that every 2 years the best performing fund manager keeps changing, and Harsha, of course, is a lot more consistent. So with due respect, in fact, they are amongst the more consistent ones. That is my personal observation. But generally speaking, what you have seen is that every 2 years the best performing fund manager keeps rotating, correct? And that happens because everybody has a preferred, some style, like, some recipe, like somebody's growth, somebody's value, somebody is contra, somebody is high quality. So people have their own beliefs that this is what will ultimately help them outperform the benchmark or create wealth over long term. And why the rotation happens is because when macroeconomic factors change, like interest rates going down instead of going up, government policy for PSUs being pro versus anti, right? Rupee appreciating or depreciating. So many things can happen. So when macroeconomic parameters change, then which style, sector, and factor is performing will also change. So as a result of that, what we try to do is try to run a very balanced portfolio, meaning balanced for style, sector, and factor. And any active weight that we have should emerge out of actually the stock positions and not out of the sector positions. So why I've given you this background is because times like this, see, in 2023 and 2024 till June or July, I used to meet wealth managers who used to say that my client came with his 25-year-old son or daughter and says, what are you managing? My 25-year-old son is beating you hands down, right? So when the market has some real high beta stuff, high octane stuff happening, like, in 2023, if you had PSU and you had small cap, you are in, right? If you had some types of cyclicals or railway, infrastructure, energy. So when the market has haves and have-nots very clearly, and there is no heterogeneity, right? One bunch of stocks is doing very well, the other bunch of stocks is clearly not doing well. That becomes difficult for us. Stock pickers or bottom-up managers, they do very well when there is heterogeneity in the market and there is no tick box phenomena that, it's no have, like, right now, for example, across sectors, you can experience heterogeneity and you can, pick stocks which will outperform. There are years like 2023 or early 2024 when stock picking works less. What type of sector or which segment of the market are you owning? That matters more and stock picking matters less. So if you ask me, this kind of environment is good for generating alpha, while the beta itself or the nominal return is not great. But in this environment, alpha generation becomes, nothing is easy, but it's more possible right now.
So you would focus more on stock selection and be more or less neutral on sectors, or that's the strategy more or less, right? So Vaibhav, as a wealth manager, what would be your advice? How should people think about it?
See, asset allocation is the only proven way of creating wealth over a long period of time. If you're disciplined about investing in multiple asset classes, you are able to rebalance your allocations periodically, you'll be able to generate good amount of wealth. Maximum amount of losses happen on count of two things. First, we are chasing past winners. A very interesting example, the amount of money that we are seeing going into precious metals at current levels is 100 times of what we saw happening 1 year ago. If we had flipped the equation, then the outcome would have been very different for the investors. As I recently received this notification from Money Control, where that spoke about two stocks, Loda Real Estate at 52-week low, Hindustan Zinc at 52-week high. If you go back in time 2 years ago, the headline would have read completely differently. Loda hits 2 years high and Hindustan Zinc hits 52-week low. So obviously this cyclicity is there in the market. The only way to deal with the cyclicity is to maintain discipline around asset allocation. Have your money invested across asset classes. Buy when valuations are low. Overvaluation happens not only in equity, but it happens in fixed income also. It happens in commodities also. So you have to make sure that you are spreading your money across asset classes. And whenever there are excesses which get created in any asset class, you correct that. Aashish gave a great example of PSU and defense bubble which was there in 2024. Everyone wanted to invest money in those sectors. And most of the NFOs which raised money in those sectors at that time are still sitting on 20-30% losses. So the best way to deal with this is follow your asset allocation, be with diversified funds. Look at pockets of overvaluations, not just in one asset class, but other asset classes also, and keep rebalancing your portfolio. Behaviorally, we will continue to react much more than necessary to these headlines which keep playing out. Last year, we had India-Pakistan war, we had tariff tantrum which played out. Before that, we had Israel and Middle East issue. Before that, we had Russia and Ukraine issue. So every year, we had some geopolitical event over last 3 or 4 years. Fortunately for us, markets have delivered positive returns in all of these years. But to sit through that volatility is very difficult. And that's where your behavioral edge comes into play. And that's where your asset allocation discipline comes into play. So my view is that the only way to win over yourself is to maintain a disciplined asset allocation and stay invested across asset classes.
Ashish, your thoughts on this?
See, I think, practicing asset allocation becomes very difficult, but I'll tell you two personal experiences. Once in a while, there is a newspaper publication which once in a while interviews CEOs and asks them, where do you invest? Okay. So in 2021, when I was interviewed, I did not know कि सच नहीं बोलने का रहता है. So when I was interviewed, I said I invest in real estate and in equity. Just said that, right? So then it was put up on social media, and I got so much flack for saying that I invest in real estate, because in 2021, there was previously, and I was not investing in Hyderabad. So before 2021, real estate was a disaster. So when they interviewed me and I said I invest in equity and real estate, so I got a lot of criticism. After that, I never gave that interview. Okay. And then I'll give you one more experience. In 2023, we were launching a fund in 2023 when everybody was investing. Equity was doing very, very well. 23, when Silicon Valley Bank happened, there was a blip. But after that, from April 23 till straight October 24, market went from 17,000 to 26,000. Okay. And in May 2023, when market started to go up, we launched a fund which had some 30% allocation in gold and silver. So everybody thought, what are you doing with gold and silver? We didn't get any money. Nobody invested. Okay. So now see what is happening now. Okay. So you cannot predict what will happen. Like there's a proverb that, with due respect to animal rights, there is a proverb that you have to shoot where the rabbit will be. That statement is useless because you never know where the rabbit will be. But that statement tells you definitely don't shoot where it was. Correct? So what happens is that people always chase, when it rains heavily and you're driving a car, there is a wiper in your car, right? So how does a wiper work? Waterfalls, it wipes. Either wipe karega to pani idhar girta hai. It comes here. Then waterfalls, it comes here. Obviously, I'm not here to talk about cars and wipers. The point is that if return comes in this asset class, people invest there. When they invest there, the return moves to another asset class. Then they invest there. So our own industry, see, like Mr. Buffett said, be greedy when others are fearful, be fearful when others are greedy. You should know what others are doing. The secret of success is not to do what others are doing. So you should know what others are doing. And our industry publishes that data every month. In September 2024, every month some 30,000 crore goes into equity and hybrid funds, X of arbitrage. In September 24, out of 30,000 crores, 13,000 crores went into sector funds and thematic funds. And they were not some banking, healthcare, FMCG. Those sector and thematic funds were railway, defense, PSU, infra, manufacturing, etc. So in September 24, when stock market was booming, 13,000 out of 30,000 went into sector and thematic funds. Take a wild guess, what was the number for gold? 1,000 crores. 1 year down the line, come to September 25. Sector funds and thematic funds. 1 year down the line, lot of water under the bridge, no returns, some sectors are negative. 13,000 crore net became 1,000 crore. Gold, 1,000 net became 8,500. And nobody was talking about silver. That comes in other ETF. That also became 8,500. Now quickly fast forward to December 25. Sector fund, thematic fund has fallen further to 900 crore net flow. मतलब 13,000 crore का 900 net flow हो गया. Do you know where is gold and silver? In December 25, gold is 11,500 crore net flow. And that other ETF category which has silver is 16,000 crore net inflow. So the trick is just be asset allocated, because you will never be able to, it's very important to be asset allocated. You can never predict what will happen next, but you have to calibrate yourself amongst asset classes and ensure. See, successful investors never take extreme positions. They're never like black or white, right or wrong. Successful investors are always kind of ambivalent, and they calibrate across spectrum of gray. That is very important.
Great. Thanks all the panelists. So, gentlemen, we promised that Baigan ka pata nako, and I think we delivered exactly that.